Let's be honest, when people hear carbon pricing, most of them think of one thing: taxes. Government charges at the pump, you pay. Government taxes industries, you pay. Rising utility bills, transportation costs, the list goes on. No matter how good it is for the environment, it's more money out of your pocket. And if you've ever thought it sounded more like a scheme for rich countries or big investors to cash in, you're not alone. But what if there was another way to do this? One that worked with markets, not against them. One that actually paid countries for doing the right thing. That's the idea behind Article 6 of the Paris Agreement. It's a part of the climate deal that barely makes headlines, but according to the World Bank, it could cut the cost of global climate action in half. That's over $250 billion in potential savings by 2030. Here's how it works. Instead of taxing emissions at home and hoping for the best, countries can now trade emissions reductions. Say Canada finds it expensive to cut certain emissions, but a partner like Ghana or Peru can do it more affordably through reforestation or renewable energy. Under Article 6, Canada can invest in those reductions and count them toward its own climate targets. It's not a tax. It's a market. Emissions reductions become a tradable commodity, kind of like oil, but in reverse. Instead of producing energy and releasing carbon, you generate reductions and sell the absence of pollution. This isn't a fringe idea. Article 6 was finalized at COP26 in 2024 in Glasgow. It came after years of negotiation over how to avoid double counting reductions. Countries now have to follow clear rules and make corresponding adjustments to their emissions ledgers. That means every traded credit is accounted for, and no one gets to fudge the math. It's already happening. Switzerland has signed Article 6 agreements with countries like Peru and Ghana. Quebec has linked its carbon market to California's. Japan is running over 100 pilot projects through its joint crediting mechanism. These aren't theories anymore, they're functioning models. But let's pump the brakes for a second. If this all sounds like the future, the truth is, we're not there yet. According to Carbon Brief, the politics of carbon trading are still fragile. The idea might be sound, but the world's economic structure isn't fully built for it. Right now, many of the largest economies still rely on fossil fuels for a huge chunk of their GDP. Oil and gas don't just power economies, they bankroll them. In places like Saudi Arabia, Russia, or Alberta, fossil exports are the lifeblood of government budgets. Even China, which has its own carbon trading system, is hesitant to commit to stricter Article 6 rules. Why? Because transparency and enforcement might limit their ability to grow on their own terms. The United States, under different administrations, swings between climate leadership and outright resistance. The Carbon Border Adjustment Mechanism from the EU, which aims to tax carbon-heavy imports, is already causing tension with US trade policy. This is the reality. The world isn't unified on this yet. And some of the most powerful countries aren't just dragging their feet, they're actively pushing back. But here's the flip side: the direction of travel is clear. Despite the friction, Article 6 is being implemented. Despite the resistance, carbon markets are forming. And despite the noise, private capital is moving fast. The International Emissions Trading Association, IETA, which represents banks, energy firms, and industrial players, has repeatedly said that Article 6 is the missing piece of the Paris Agreement. Not because it makes anyone feel better, but because it creates something valuable, a new class of assets based on emissions reductions. That's why analysts, from the World Bank to climate economists, argue that once the infrastructure is in place, carbon markets will be too efficient to ignore. Countries that resist them may save time in the short term, but they risk isolation in global trade. And that's where Canada comes in. See, Canada sits at a crossroads. We still rely heavily on oil and gas exports, especially in Alberta and Saskatchewan. But we also have a strong clean energy sector, vast forests for natural offsets, and a federal carbon pricing system that already works with market principles. According to the Government of Canada, we're also one of the few nations that explicitly plan to use international credits toward our climate goals, meaning we're preparing to be a buyer in the Article 6 market. But what if we also became a seller? What if Canada exported not just lumber and oil, but verified emissions reductions? What if our banks traded carbon credits, our engineers built Article 6 projects abroad, and our environmental firms got paid to monitor global emissions cuts? That's the vision, and it's not unrealistic. Carbon Brief notes that high-integrity markets could nearly double the impact of global climate action. And the World Bank projects that countries participating in carbon trading can meet their targets more affordably, with extra room to innovate. For the average Canadian, this matters. Why? Because every dollar not spent on expensive domestic emissions cuts, if those reductions can be sourced cheaply abroad, is a dollar saved. That means lower costs for industry, fewer price shocks for consumers, and more space to grow sectors like clean tech, forestry, and carbon capture. In other words, we can meet our targets without wrecking our economy. We can make our targets and even make money off doing it. Look, there's no sugarcoating it, the world is still divided. Some countries will slow roll Article 6 to protect their fossil revenues or growth models. And that will delay some of the benefits. But as the World Bank, Carbon Brief, and the UN all point out, it's not a question of if this system goes global. It's a question of when. Markets, trade policy, investment trends, all of them are aligning behind the same direction. Carbon will be priced. Clean growth will be rewarded. And those with a head start will lead. Canada has that chance, right now. Not because we're perfect, but because we're early. Not because the system is flawless, but because we're in position to shape it. So whether you believe in climate change or not, whether you think net zero is essential or overblown or an outright scam, you can probably agree on this: making money off of emissions reduction sounds a lot better than just paying for them. Article 6 is the global economy's next chapter. The only question is, will Canada help write it?